then.
Perfect. And then let me allow you to share your screen as well. Okay, all good.
Okay, perfect. So good morning, everybody. Thanks so much for having me. Today, I wanted to talk to you about a couple of things that are hot topics in the market. Interest rates, which I'm sure you're all dealing with questions about interest rates, and then my perspective on the question of when is the crash coming, what's going on with inventory, all the things that you're probably hearing from your buyers when you're out at open houses. So those are the two things that I'm going to cover today. And then, of course, I'm open to any questions that anybody has either during the presentation or at the end. So just a quick intro. My name is Seth Conley. I work for Mason McDuffie Mortgage. I think I've met most of you, or some of you at least. My office is right downtown in Tracy at the corner of 11th and Central, right on the corner. And I've been in the mortgage business for just over 5 years in the modern era. I was in it years ago, from 2007 to 2009, but I entered back in around 2015 and have built up the business and the team here in Tracy, actually serving other states as well. I'm licensed not only in California, but Florida, Texas, Idaho, Nevada, Arizona, and North Carolina. So all the places that people are looking for properties that are currently in California. So one of the questions I'm sure that you're getting at open houses is what's going on with interest rates, what's happening in the market, why are interest rates going up so fast, you know, what's happening in the world that's causing all these changes in numbers, and how is that affecting affordability? That's really a lot of the questions that I'm getting from my clients, and especially buyers that are trying to enter the market or getting frustrated that their offers aren't getting accepted. They're seeing their payments just go up so much when they're redoing the pre-approvals with me that you know, people are having lots of questions. Should they slow down? Is now a good time to buy? What's going on? So there's a couple of things happening that you need to be aware of, and it's really hard to get to the truth of what's going on when you're watching the media, or even if you're looking at the Fed, at what they're doing and some of the comments that they're making. The biggest driver right now of what's happening with interest rates is inflation. Yes, the Fed is trying to curb inflation by raising their interest rates. Remember, Fed funds rate is different from mortgage rates. It has an impact. But when the Fed makes their changes, when they do things like adjust the Fed funds rate by 50 basis points, that has an impact on the bond market, which in turn has an impact on the mortgage rates as well. So what we're seeing is, as inflation starts to go up, due to all the things in the economy that are happening, the excess money supply, supply and demand imbalances, all these things that are causing inflation to go up, the Fed, their job is to try to slow that down. So what they have is a tool to slow it down, and that's what they raise the Fed funds rate to try to slow down inflation. And as they do that, you know, it affects the bond market, and mortgage rates go up as well. So just to give you a quick quantification of what's been happening, less than 6 months ago, interest rates were in the low threes. I mean, we had this big refi boom over the last couple of years. You know, purchases were going crazy. All this cheap money that was in the market, people's interest rates were the lowest they've been in history, below 3% in a lot of cases. And now, a short time later, we are approaching 5%. And actually the report that came out from Freddie Mac last week said that we're at 5.1%. So there's been this huge run up in interest rates. And I just want to show you, and it's a real easy tool that you guys can use. And I want to give you some cautions with it as well. But just the mortgage calculator that I like to use when I'm on the phone talking to clients is just the Google mortgage calculator. If you Google the term mortgage calculator, it's one of the most common search terms on the internet. You know, the big companies like Quicken and all these online lenders, they buy these search terms for thousands and thousands of dollars because it's the most common thing related to mortgage that's on the internet. So be careful when you actually search for mortgage calculator. You may get ads that come up, and that's here below, all these different ads. But Google started using a tool just to keep people on their page, where they built in this mortgage calculator, and it's the best tool that's out there to get a quick idea of what's happening. And if you look at their interest rate that they're actually suggesting in here to start with, it's over 6%. So that's interesting to see today. But what I like to do is just come in here and give you guys an idea of what the difference in payment people are looking at for their mortgage. So, you know, say someone's looking for a house in our market, you know, $600,000 to $800,000 range, maybe the range they're shopping in. I know that's getting to be on the low end, but maybe as some of the areas that we're working in, $600,000 to $800,000. So if they're putting 20% down, I know not everybody has that, but let's just use that for our simple mortgage calculation. So that would mean that they have a $480,000 mortgage. So if we go in and we put $480,000 here, then this is going to show just their principal and interest. Remember, it doesn't include the taxes and insurance for this 2155 mortgage payment. So this is where they were about 6 months ago, maybe 3.5% for this scenario. So now take a look at what happens when we go, remember the number's 2155 that we're starting at, and say we just go up to 5%. So that 2155 went up over $400 on their monthly mortgage payment for their principal and interest. So it's a really easy way to just calculate where people's payments are going to be and look at what's been happening with these trends. And the point that I wanted to make with this is, yes, people's mortgage rates have been going up. You know, in this scenario, it's over $400 just because of the interest rates. But what that really relates to is the affordability. And that's what we're hearing, some misinformation in the media, but I wanted to help clear up for you what's happening. So it's absolutely correct. Mortgage rates are going up, causing people's payments to be much higher, and that's expected to continue to increase. All the indicators that I watch and the experts that I keep up with are predicting that interest rates will continue to increase as we get into the fall season. And then after the Fed takes their action and we get into a recession, then interest rates should come down at the end of this year and into 2023. So there is some hope that there's a change coming, but I think we're still in a pretty rough ride for the next few months. But the important thing to tell your clients and even your sellers that are worried about this affordability and how people are going to be able to afford the rising cost of housing and the rising interest rates is you have to remember that people don't spend 100% of their income on housing, right? The ratios that I have to work with when I'm qualifying people are between 30 and 50% of their income. So incomes don't have to increase as fast as the interest rates for people that still have affordability. So for example, if somebody is making, which isn't unrealistic, if they're making $1,000 more a month over compared to the last couple of years, they only need to be able to put 50% of that towards the mortgage. So even though that mortgage payment looks like it's going up $400 or so, if they're making $1,000 more a month than they were a year or two ago, because wage inflation is real too, people are making more money, then they still have affordability in the housing market. So that's one of the myths that's out there is there's this big affordability crisis. Yes, some people are going to be priced out of the market, but the second thing I wanted to talk about is the inventory. And from my perspective, what I see on that. So I just wanted to, I'll share this other little slide that I took a picture of this morning during one of my my morning update calls that I listen to for the state of the market each day. And let me just show you here what's been happening with inventory. As all of you are probably aware, the inventory in the market is you know, something that people want to compare to is what happened in 2007 and the housing crash that we had at that time. So, you know, we talked about rising interest rates and what that's doing to people's payments, but now let's take a quick look at the inventory and what's happening. These are nationwide numbers and people always want to compare to 2007 and 2008 and the crash that happened at that time. And it's important to have the truth and the right information to help rebut some of these questions that are out there and the misinformation. And if you take a look back at the numbers from 2007, 2008, not only were there fewer buyers in the market just due to demographics, there was a population dip about that time of people that were in their 30s buying homes. So not only was there a population dip at that time, but there was an overabundance of inventory. So if you look at the 2007 numbers, there were almost 4 million homes available in the market for sale. And as we got through the housing crisis, you know, more buyers started to enter the market and, you know, eat up that inventory. Basically, when we got to more of a normal market in 2012, there were about 2.3 million homes for sale at that time. And then as time went on, we really saw the impact of the millennial population and the numbers of first-time home buyers entering the market, people with good jobs in their 30s, starting to think about having families, moving out of the cities, putting pressure on the housing market. So when we got to 2017, there was even less inventory in the market, about 1.8 million. And now we're sitting in 2022 at less than 1 million homes for sale nationwide. So not only do we have the pressure of rising interest rates that are having an impact on the market and the buyers that are out there and their ability to afford their mortgage payments, but we have this inventory problem where there's less than 1 million homes currently for sale in the country. And what I always tell people in our area in California, that's even more exaggerated. We've got this big population, a lot of people moving out of the city and into the valley where we are. And that's putting a lot of pressure on the limited inventory, which I know everybody sees the effects of when there's an open house. There's all these people coming through and multiple offers and people asking what's going on with the housing market, but it's really a supply and demand imbalance. And when you look at it from a nationwide perspective, knowing that there's only 1 million or less homes for sale on the market is a pretty stark imbalance. I say it's a 5 to 10 to 1 imbalance. So you've got between 5 and 10 buyers for every 1 home that's out there. And I think that's a conservative estimate. So, wanted to arm you guys with some actual truth of the information that's out there. There's a lot of anecdotal information. People are saying, oh, there's this crash coming, or, interest rates are having this huge effect on affordability. And a lot of those are just the headlines to really grab you. And there's other truth behind that you need to dig into. One other study that I wanted to point out that your clients may have read or you may have seen over the last week or two, there was a report from Zillow that came out that showed the, I don't have a capture of this slide, but you can find it if you look for the latest Zillow home price report. It shows this run up of prices that's been happening over the last couple of years and shows this appreciation that's been 10, 15, 20% year over year on home prices. And they came out with a report that everybody kind of took the wrong way a week or so ago, that they revised their numbers that they said we're not going to have the same appreciation. And they revised that down to somewhere between 10 and 12%, I think. And what the media, the headlines took away from it was that Zillow had revised their appreciation numbers in a way that looked like the housing market was going backwards. So you have to remember that those reports that come out from Zillow, they're showing you what the rate of appreciation is projected to be. It's not showing when they're reducing their numbers down, it's not showing that there's some depreciation going on, that prices are falling. They're showing that the rate of appreciation is slowing. So that's really an important thing to understand when you're looking at these numbers and when you're talking to your clients, trying to explain, this is what the headline is that we saw. It looks like Zillow says that things are going to crash. We went from 20%, now it's down at 15%. What does that mean? Well, the great way to think about it, I think, is to compare it to a car going down the highway. There's a car going 100 miles an hour down the highway and they slow down 20%, they slow down to 80 miles an hour, then they're still going pretty fast in the forward direction. So that's the way to look at these numbers when they talk about the rate of appreciation and that slowing down. Then yes, the interest rates are having an impact on that. Limited inventory is having an impact on that. But the overall effect is that housing is still very strong. And there's this appreciation that's still predicted in the market for the next years to come. It just may not be at this crazy rocket speed that we've seen of 20% per year in a lot of the markets that we're working in. So those are a couple of things that I wanted to cover on the news and the media side, and how to calculate some quick mortgage payments and talk about affordability with people. And I'm happy to open it up to questions if anybody has any specific questions on those topics, or if there's other specific mortgage questions that anybody wants to ask. So I'll pause here for a second. If anybody wants to ask a question, you can go ahead, or I can move on to another topic.
Can you repeat your the states you cover?
Sure. Yeah. So the states I cover are California, of course. That's where I'm located with my team. But as COVID went on and I saw what was happening over the last couple of years, I added on 5 other states. So I've got North Carolina, and these are all based on transactions that I had of clients or friends and family that were buying properties or actually moving to these other states. So North Carolina, Florida, Texas, Nevada, and Idaho, and Arizona is also coming online in the next week or two. They take a little longer to approve the branch license. There's actually 6. So North Carolina, Florida, Texas, Arizona, Nevada, and Idaho.
Thank you. And one more question.
Sure.
So yeah, because I'm part of like a real estate investing group. Yeah, because they're from all over the states. So yeah, I was just wondering, do you work with like fix and flips? Like what type of loans do you provide?
Yeah, so that's a great segue, because the next topic I wanted to cover was the different types of loan programs that are out there in this competitive environment, and who's winning from my perspective, who's going to be the winners of this of the current market. We know it's really hard to deal with first-time home buyers. You know, it's really hard to get their offers accepted right now. FHA, you know, conventional loans with low down payments, combo loans that I do a lot of, you know, in these jumbo markets that people can't qualify for a jumbo loan. They need a 5% down. So we do 2 loans, you know, all these things that make the buyers look weaker to sellers. You know, that's a perception problem that I know you guys have a really tough job trying to pitch to clients, and when they don't have a big down payment, to try to, you know, get the story to the seller that these are strong buyers that are going to qualify, the loan's going to close, you know, all the kinds of things that you're dealing with. But I'm really seeing all those people, unfortunately, missing the boat of being able to buy homes, because right now there's a lot of cash buyers. Number one, you know, there's a lot of people selling with a lot of equity that are coming in with cash and beating everybody out. And then the other thing that I'm seeing is a lot of investors, and that's what you're asking about, Justin. So the investor programs that I work with, yes, there's fix and flip programs that I can help with, all the way, you know, through hard money loans and all these kinds of things. My company that I work for, Mason McDuffie Mortgage, we're a mortgage banker and a broker. So we're both. We lend our own money. We have in-house programs. We, you know, do all the conventional Freddie, Fannie, VA, FHA, all those regular types of loans that you see everywhere. But then we also have the ability to broker out to other alternative lenders. And I've built kind of a niche with investors and self-employed people. And those are the people that have this investor mindset. What I talk to a lot of my first-time home buyers that I'm getting pre-approved, I talk to them about having an investor mindset, because what's happening with a lot of the home buyers that are they're very well qualified, but maybe they don't have the down payment, and they start to get nervous about rates going up and what their payment's going to be. And, you know, if we show them historically what's happened over the last year with home prices, having more of an investor mindset of buying this home, yes, it's going to be tough. Numbers are tight, payments are going up, rates are going up, but look at where you're going to be a year from now. Look at where you're going to be 2 years from now. If you buy a $500,000 home and it appreciates 20%, then that's $100,000 in equity that you made. So if your payment is $400 higher a month, that's $4,800 over the year that you're paying to net $100,000 in equity, right? Who wouldn't make that investment? So that's kind of the investor mindset that I'm trying to communicate to first-time home buyers. And it's hard because, you know, they're scraping for the down payment. They're maybe at the limits on their DTI, their income. You know, they have to pay something off or get rid of other debts. But that's really the mindset shift I'm trying to have with those buyers, because all the investors are coming in and they already have that investor mindset. They say, I don't care if the interest rate's 7% because I'm paying, you know, I'm buying this as an investment property. And there have been some changes with Fannie and Freddie that if you're buying an investment property or a second home, those rates have been jacked up also, even more so and faster than primary residence rates. But a lot of those buyers that I'm working with, they don't care. They know that they'll pay 7% or sometimes even higher if there's one of these fix and flip programs or something like that, then to make that 20% at least. If they're doing a fix and flip and they've got this big equity position because they've done a renovation and now they can sell the property, then it's an even bigger no-brainer. And that's what I'm trying to say is with these buyers that are struggling to have the right mindset, you know, it's easy to want to help everybody, right? And we've been in a market where a lot of the buyers really need our help and our expertise, and you guys have a really tough job as the realtors to go out and show property week after week and not get offers accepted working with these buyers. So for me, I've been trying to be more selective with the people that I'm pre-approving up front to test and see if they have that mindset that this home is an investment. Yes, of course, it's your family home, hopefully your forever home, maybe not, but looking at the equity and the opportunity a year from now when rates come down again, you can always refinance, right? You can always restructure the loan. The home is the product that you're trying to get, the stability for your family, the investment that you're trying to make. The mortgage is just the tool to get there. And yes, sometimes things are more expensive. You have to make some sacrifices, but having that mindset of looking ahead to the investment is really what I'm trying to get along. And this is a long way to come back to your question of types of programs. But yes, we can do fix and flip, but the one that's more interesting for me right now is called a DSCR program. And I don't know if you guys have heard of that before. Justin, have you heard of that? Okay.
I heard of it, but I just forgot what it meant.
Okay,
What
so
is DSCR?
DSCR stands for Debt Service Coverage Ratio.
Okay.
And this is a really popular program right now. It's it competes really well even against cash buyers because it's a quick close. And the reason for that is because there's no income verification. So if you're buying a home as an investment property and putting 25, sometimes you can do 20% down, but usually 25 is the best scenario. If you're putting that big chunk of money down, then the only real test that the lender is going to have is they have to be credit qualified, usually a 660 or better credit score. And you just have to show that the rents are going to cover the mortgage payment with the taxes and insurance. So the appraisal that's done on these properties is an investment property appraisal. And they also do a market rent survey of whatever the rents are in that neighborhood. And when that survey comes back in the appraisal report, as long as it covers what that mortgage payment is, and it usually will because they're putting 25% down, then there's no other income verification required. And one of the cool things that's been happening is that some of these lenders have been actually moving quickly enough to keep up with current market trends, and they can use short-term rental income. So Airbnb income can be used to qualify for these programs also, which is a big change that they finally got caught up in the last year or so, because that was frustrating people that, the market rent for this 3-bedroom house may be $2,000, but if you're Airbnb-ing it, you're making $6,000 a month. So, why can't you use that to qualify on these programs? And the other one that is really interesting that kind of relates to this is the self-employed income programs that are out there. So I work with a lot of self-employed people, a lot of realtors that are buying properties. And it's always hard to look at those tax returns and say, yeah, I made a couple $100,000 last year, but because of all my write-offs and the benefits of being self-employed is that you can lower your tax burden by covering all your business expenses, right? So you may have a top line of a few $100,000, but the amount that you're paying taxes on is 30 or 40 grand. And the traditional programs, the conventional loan programs and jumbo loan programs, those rely on just that bottom line income that you're paying taxes on. That's just how the rules in banking work. So there's alternative lenders that you can use a bank statement cash flow program where I can look at 12 or 24 months of your bank statements, determine what the average monthly deposits are, and then make an income off of those that we can qualify you on. And those are really popular programs with what I'm doing right now. I've got a guy who you guys will like this story. As realtors, a realtor came to me and said, I have this client, he's making tons of money, but no bank will loan him anything. And I said, great, he's probably, cannabis industry or cash business or something like that, right? And there's programs for that now. So there's all these different outlets if you know where to look and which lenders to work with. There's all these outlets that you can find these solutions for people. And I love finding creative solutions. So I said, well, what's the business? How come the banks won't work with them? And they said, oh, he's a professional poker player. He's been doing it for over 4 years. He makes over 400 grand a year playing poker. And he claims it on his taxes even, but the banks won't work with him because it's all cash deposits, right? There's no W-2, there's no 1099. The interesting thing about, I've worked with people that have used casino winnings before for down payments and that kind of stuff. And there's usually a W-2 that they get, right? When you cash out at the cash cage, if it's over a certain amount, they give you a W-2 and take the taxes out. So you have a record of it. But for poker, since you're not taking the casino's money, you're taking money from other people. There's no record of it. It's all just cash that's changing hands. And so anyway, the point of this is I was able to get him to qualify for a self-employed, it's his business, a bank statement program where we could look at his bank statements over the last couple of years. And now he's buying a $1.7 million house in Three Rivers, California, which is near Visalia and Sequoia National Park. And it's on the river. It's beautiful. And it's going to be a great home for him. He may, Airbnb some of the rooms out, but it's, finding creative solutions. Those are the people that are going to get ahead in this market, because he was, he didn't like the interest rate. It was 7.5%, but that's what it is. I mean, he can't get any better anywhere else. He shopped around and, tried to find something, but that's just where the market is right now. Everything's gone up 1.5 to 2% on all these programs. So that includes these alternative programs, but he's going to make 20% appreciation on this almost $2 million house year over year, at least for the foreseeable future. So yeah, to answer your question, we can do all those programs, and there's tons of creative solutions. My biggest thing right now is finding the people with the right motivation and mindset, because it's so frustrating. I've got a stack of lots and lots of pre-approvals that people are just, they think a crash is coming, or they don't like the interest rate or whatever it is. And I'll check in with them week after week and just see where they're at. But they're not motivated to be aggressive in the market. And we all know that's what it really takes.
You might be getting a whole bunch of calls, because I have a lot of people I'm in this future flipper rookie program, and they're like in the group chats are like, does anyone know any more lenders? It's just who's just from all over the country. And that's why I asked what states you covered. So,
my company is licensed in a lot of other states too. I hold those licenses personally, but I can usually help in most states through internal referrals in my company. So I can usually get it started and find the program and then get it done. The other interesting program, since you brought up those, there's a doctor mortgage program that has been out there, but not many people know about. So the quick overview on doctor loans is it's basically a no down payment loan, and it's made for doctors with high amounts of student loan debt, right? That can be something that is difficult in their mortgage qualification. So we're allowed to exclude their student loan debt from the qualification, and they can have no money down, and they can actually even get the mortgage and close on the house before they even start their job. While they're still in residency, they have an offer letter that's starting, it could be 6 months from now. But if they have this offer letter and a job that their residency is going to transition into, or anywhere else, then we can do a doctor loan for them. And it's an awesome program. The rates are actually really great. The philosophy is that doctors are very highly ethical, and they don't want to put their assets at risk. So they're going to make their payments, right? And they're going to be high income earners or good cash flow anyways. So those programs are out there too, if you come across any people in those, and they're very highly motivated individuals also looking for solutions, because when they go to the bank, sometimes they get disqualified immediately from having $200,000 in student loan debt or whatever.
Okay, thank you. Sorry, I've got another question, because you mentioned being creative, right? So creative financing is a big term that investors use. I follow this guy. He's all about doing these sub-2 deals. Subject to just taking over the mortgage.
Yep.
And just with the due on sale clauses that could be out there. What are your
so those are more difficult to get mortgages on. Those are usually seller financing or private money, hard money that's out there. I have connections to give hard money. When I run out of solutions and I exhaust everything, then I can find a hard money solution for people. But typically those are investment groups that are coming in and making those kinds of investments. So I'll usually refer those out to hard money. And the great thing for me is having those contacts and starting those relationships and showing them, we've looked at all these options. There's A, B, and C, and now we need to go hard money. Is that, 6 months later, they do the rehab and they've got buyers that are coming in that you can help. Or, it's a refinance opportunity for me that I know they went to this hard money. Now we can refinance them and get them into a more traditional loan program, or even one of the self-employed or alternatives. So as long as people are motivated, that's my biggest thing right now, right? We spend so much time trying to help everybody, which is definitely what we need to be doing with the education. And it's just for us to protect our businesses, and we're all in this as partners together, on the mortgage side and the real estate side, we need to find people that are gonna make our lives a little bit more bearable in this tough market of inventory. That's the biggest struggle that I see right now, is the inventory. Rates are going to be what they're going to be. People are going to qualify or not. But if you have people that are on the fence, then they're really sucking up a lot of your time with not making a decision. So having a process to follow up with those people and stay in front of them for when they do make the decision to move forward. But having a pipeline of people that are motivated is really what's important to me right now. And I think for you guys, that's my sales tip for the day is find those people that aren't going to be I don't like to say waste of time because we want to help everybody and they eventually turn into opportunities, but be efficient with your time and work with the people that are motivated in this market. Okay, so I'm at the end of my time. I could go on. I love this stuff and I love the creative financing stuff, as you can tell. You know, I'm working with a couple people that are in the movie business, you know, trying to figure out how to handle their royalty income to qualify, all these creative things that once you start getting referrals from some of these groups, like this creative financing group or investment group, then there's all kinds of interesting scenarios that come up. So I'm happy to talk through any of them. My information is always Mortgage Seth. You can see that's the name that I have up there. My website's mortgageseth.com. If you search for Mortgage Seth on YouTube, you'll find me. Instagram, Facebook, everything's Mortgage Seth. So there it is, mortgageseth.com. Thank you. My phone number, my office number for the Tracy office is 209-845-SETH, S-E-T-H. It all comes back to my name. And interestingly enough, the little bit of trivia, the only other Seth that you'll find when you look for mortgages typically is Texas, because there's a program called Southeast Texas Home Buyers or something like that. So it's Seth, but that's not me. Everything's Mortgage Seth. It'll have my face on it. But there's some good videos on YouTube that talks about a lot of these programs too, if you go to my YouTube channel. And then I have an app that I'm happy to share with you guys. If you go to my website, my email's on there. Just shoot me an email. I can send you an app. It's co-branded and it really makes it easy for you to refer me to people if you want to do that. You know, it comes up with both of our pictures on there. You can just refer it out. They fill out the information and I've got a whole process and a team that intakes the apps and does the initial evaluations and puts me in contact with the right people. So,
Thanks so much for your time, Seth. I know that we're 2 minutes behind. So
absolutely.
Thanks everyone.
Thank you. All right. Have a great day, everybody.
Thank you.
Bye-bye.
Have a good day, everybody.
Bye. Bye. Thank you, Seth.